speakers to join us today in this webinar. Gulf economy remain very important, and I think we have had a great impact since March this year, and the Gulf economy, being it in the government spending or government project or even imports, or the impact on the small and medium-sized businesses. There are so many, so much, things to think about it and to look at it. Also, we start, receiving more information about government budget this year, next year, the gap, the deficit, and all of these issues. I'm glad that we have a great pool of experts here that they will enlighten us and keep the debate alive. And I'm very thankful to Dr. John Sfakinakis, our chief economist, that is moderating and leading the talk today between this, wonderful expert. And I'm, very thankful also for those whom they joined us as a listening participant. I'm sure we can get some of the questions once you are done. And Anoud, as a moderator, she will, as the technical supporter, she will pass it to Dr. John, and perhaps you can select or group some of those questions. We do want to make it longer than what it normally should be, an hour and a half, but I'm sure it will be, great. Thank you all, and welcome. And I pass it on to you, Dr. John, and good luck.
Thank you, Dr. Abdulaziz. It's not only a great pleasure, but also honor to have the 6 very, very distinguished panelists to address the issue of how do we see in our own perspective the future of the Gulf economies. Having said this, I wanted also to congratulate the GRC, the Gulf Research Center, for its 20th anniversary. This is something very important because think tanks are not too many in the wider Gulf region and in the Middle East. And so what I want us to do today is to share our thoughts and your thoughts with the wider public as to where we see the region going. And one needs to be constructively critical. There are a lot of people, there are 6 people who we have invited, and I think they're excellent in their own ways. One thing that I want to air, myself as an economist who has been living and observing the Gulf and principally Saudi Arabia, is that in 2014, 2015, when the oil crisis started, the first oil crisis, we thought that maybe this is not going to be a long-lasting one. We were coming off from a very unusual period of high oil prices, the longest period that the region has witnessed in terms of oil prices. And a lot of my colleagues said that, look, this would be maybe another 1 or 2 years of difficult years, and we will recover. And it seems that this theme continues to be the case. We are now in another special situation where, again, oil prices have declined further. And again, some of my colleagues are saying, well, this is going to be maybe another 1 or 2 years and things will recover again. And I am of the view that the next 5 years will be more challenging than the previous 5 years. And I wanted to share this as a notion, and I'm sure all of you will have interesting things to say. I want to start our discussion by introducing Jeff Nugent, who is an excellent authority on the study of the Middle East. And he sits in California. So good morning to you, Jeff. It's wonderful to have you. And I want to give the floor to you in order to share some of your ideas. I know you have some slides. Jeffrey, good morning to you. I think you are unmute. You need to unmute yourself.
Okay.
Yes. Good morning.
Good morning, John, and all of you. Such a pleasure to be with you. And as you know, things are a little bit shaky here. And not only do we have earthquakes, but we have a big election coming up. and people are bracing for what's going to happen after that. There's talk about there's going to be, people won't believe what the outcome was and so on. In any case, bear in mind that being here in California, I'm not reading the Gulf news and not up to date on all the latest recent events, but I do try to follow the journals and the books and so on about the Middle East. So please feel free to straighten me out. Now, let's see if I can, can you see my slides or not yet?
No.
No? Okay. So let me see. I need to share screen. Okay, I want to, where is it? Still no?
No.
Huh. Still no.
Still no. Maybe we should try and do it without the slides, but I know it will be challenging, Jeff.
I should be able to do it, but can't see why it doesn't go. I apologize. This is terrible.
This is the nature of webinars. Sometimes they start with a lot of challenging things.
It's just my own abilities with this thing. I can do it in my classes, okay, but I don't know. It's not coming
Shall
up.
we move on, Jeff, in terms of, and you can maybe adjust it as we go to somebody else and then return back to you, or shall we?
Okay, maybe that's better. I'll try to see if I can.
All right.
Thank you.
So thank you, Jeff. Ishaq, since you moved to the sofa, I surprised you. Please go back to the desk. I will give the floor to you, Ishaq. Please.
Okay. I mean, I'm not sure if you want me to start just in terms of overall logic, because I want to speak about
please start.
Industrial policy in Saudi Arabia as opposed to, the short-term impact of the crisis. What do you say?
I think it will be great if you have both. It will be lovely. Start from the short term and then we move to industry.
Well, no, I mean, my presentation is on industry, but so that's what I was asking, if you wanted to start with me or leave me to the end.
No, we can start with that.
Very good. So, I mean, my thinking is basically that this shock, as you said, is going to be long lasting, and the extra effect of COVID just reminds us of how important is it to stabilize and consolidate the strategies of diversification. So I set on myself to think about industrial policy in Saudi Arabia. I must say that I teach corporate finance, so I wanted to look in the literature and figure out the various policies that are being followed to foster diversification and see to what extent we could think about them globally as a strategy. So I mean, clearly the challenge of creating jobs for Saudi women and men is very large. We're just talking in the Vision 2030 of something like 1 million jobs or created new jobs over the next 5 years. And the vision also speaks of SMEs as being major drivers for this job creation, jumping from 20 to 35, 40% of GDP in the next 10 years. There is much less focus on large firms, and I'd love to hear reaction from people that know intimately the economy of the kingdom in terms of what is perceived as the job for the large conglomerates, which remain very important in the kingdom. Now, really, when we think about jobs, those must be productive jobs that therefore can afford to pay high wages, adapted to young Saudis who are of medium skill levels, higher than the expat, and therefore we need to think of upgrading the industry and the services, but also in new sectors. And so we also have to think of new firms and new sectors. And in the existing sectors, mostly in services, how to upgrade those jobs. Broadly speaking, together with the Nitakat program that substitutes labor-intensive expats largely for more productive jobs for Saudis. And the sectors are well identified in, as you can see in the list here by the vision document, old sectors as well as new sectors, tourism, art, entertainment, and very importantly, information and communication. Now, it's important to keep in mind that creating 1 million jobs, especially productive jobs that come with machines and factories and office space and infrastructure, cost money. So if we just think of a job costing on average $250,000, which is the average in higher middle income countries, this is $250 billion for 5 years. So we need to think at a macro level before we think at a micro level at having this kind of financial space. And importantly, adjusting quickly in terms of consumption level in order not to spend all the headroom that exists on consumption, but also being picky in terms of big projects so that we think of big projects that have externalities in terms of supporting private sector growth as opposed to ending up with white elephants. This is just a chart showing how in Eastern Europe, firms that innovate most are also firms that have access to finance. Now, clearly there is a need for horizontal policies, good business climate, macro stability, as opposed to, in addition, vertical policy. I want to focus on vertical policies, but just a word on horizontal policies. Since the goal is innovation, upgrading, improving productivity, issues like access to finance, education, infrastructure are at the heart. But moreover, we have to also think about the kind of policies that create knowledge, a knowledge economy, and that increase the return for firms to innovations. And firms are very sensitive to the business climate when it comes to innovation. Now, in this broad map, the main weaknesses today from my kind of look at Saudi economy from afar are in the area of finance. The bankruptcy law, which has been upgraded, reforms remain lagging there. So access to finance remain a very important issue. I'm going to ask about competition. To what extent is competition, the forces of competition that push firms to innovate in order to gain market shares, to what extent is this working? And basically, I'm going to argue that we know some about exit of firms, but we know very little about the entry of new firms. And finally, I want to raise the issue of how to adjust industrial policies to the Nitakat, to a very important effort on Saudization, and to what extent can we expect entry with this kind of gradual shifts of technology or of production functions over time. In terms of vertical strategy, this is what we call industrial policy, and it's not about industry. Industrial policy is about all sectors. These are kind of strategies where you pick winners and you try to resolve existing market failures in order to promote innovation and development and the growth of firms. And there are already many programs in place in Saudi Arabia, from the Musha'at to the Nama to Kafala to Jadwa investments, as well as support for access to finance, equity, training, support, office space, development areas for incubator and accelerators. There are several administrations and support system in place. And that makes sense. The question we're going to ask is to what extent they're coordinated around one approach and one strategy that can deliver results. It's good to understand the challenges. The reason why we have industrial policies is to beat market failures. Number one is knowledge, what we can call knowledge externalities. It doesn't help a firm innovate if it's going to be copied very quickly by another firm. And therefore, innovation requires some subsidies and some protection. There are value chain failures, especially in new areas such as tourism, but also in more traditional areas such as construction, where you need some markets to exist for others to be born. You cannot cater hotels if hotels don't exist and the like. They're very important training externalities because we know that the kids that are coming to the market have a basic middle education but need training in order to be productive in companies. If one company trains and the other company rehire the same workers, that training cost would be lost, and so that is also an area that requires support. And there are credit market failures, especially for areas without or domains without collateral, like ICT and disruptive technologies that are going to be very important for increasing productivity. These are domains where the main asset are brains as opposed to buildings, and so it requires equity finance and special effort there. Moving on, it's important to understand that when we speak of innovation, it's not just inventing new things, it's also improving the way we do things, organizing firms, the management of firms, marketing, bringing technology from abroad, renting, buying technology. It's not just about inventing things, but it's important to adapt technologies from abroad, and therefore relationship between firms and universities are very important there. One area that is important to focus on is where innovation helps most are firms that have very low productivity. This is where the gain can be very important. So it's not just companies dealing with computers, but it's also broad distribution, construction, areas that are right now very labor intensive because it has been so cheap to import labor. And this is where the ability to increase, to innovate, increase production, create new jobs, of course, in parallel with restricting the arrival of cheap, low-skill workers. But this is where it's most possible to create innovation. Again, this is a chart from Eastern Europe showing that it is the low-tech sectors that can improve most by adopting technologies. All this, by the way, uses data from the World Bank enterprise surveys, and it's too bad that Saudi Arabia doesn't have one, because it would allow us to understand these processes much better in Saudi Arabia. This is a list of type of industrial policies in Eastern Europe: competitive funding, funding for universities, support for R&D. Many such programs exist already in Saudi Arabia. Now, the big question that I have is how to actually organize all the support in a way that is comprehensive and that can lead to results. So there is quite a controversy about the usefulness of industrial policy. And the big question is really between what extent market failures are more important or state failures are more important. Could the states get organized well enough to be capable of reducing market failure? And the challenge really is informational, for the administration that is managing the support to be close enough to the firms so that it understands their problems, but also avoiding capture. So not being so close that it gets involved in corrupt ways with enterprises. finding the right distance, being close enough to the problem to be able to resolve it without being subject to too much direct lobbying, so keeping some autonomy. And really, the empirical evidence on the success of industrial policy is mixed. It was central to the success of East Asia, but also has some success in Brazil and Chile, but there are plenty of cases where it ended up in corrupt practice. What helps a lot are these three rules. Is an environment that empowers the bureaucrats to make the right decision by being close but not too close to the firms. The paragon here is this embeddedness of the administration in East Asia in its society, a willingness to experiment and solve the next constraint, and sometimes to fail, but to be able, when you fail, to stop and exit. And very importantly, to have accountability loops, to be able to measure what you're doing so that success could be scaled up and failure can be stopped. And so the ability to monitor. In that context, the fact that we have many programs in Saudi Arabia is somewhat problematic. One has to start thinking of a way to make sure that these things add up, that we don't have duplication, or that some sectors don't receive sufficient attention. And this is, I think, I'm getting here to the end. The Nitakat program, which is necessary in order to, as I said, replace part of the low-skill jobs by higher type productivity and skilled jobs, more adequate for young Saudis. Nevertheless, that program adds a lot of complexities to industrial policies, and I think we need to think much more about those complexities. I cite a few here. Clearly, when the program started, there were too many small firms in Saudi Arabia, close to 1 million, which is a whole lot for a country that size. But also, there are many very large conglomerates, and there is a big missing middle. And it's really this missing middle-sized firm that tend to be more innovative in other countries. So a big part of the challenge is to build SMEs of, say, between 50 and 300 workers. Now, so far, what Nitakat has done by putting firms in yellow or red zones is to push a lot of firms out, and we've seen over time a lot of destruction. And that is necessary because that makes eliminate firms that are overly labor intensive, overly dependent on foreign workers, and create space in the market for new firms. But we haven't yet seen the entry of a lot of new firms, possibly because we're not monitoring them. I haven't seen any evidence that there's a big supply response in terms of new firms. But it's also possible that we don't have a lot of entry because of the way Nitakat is proceeding progressively over time, increasing the share, the necessary share of Saudi workers in firms. And a firm will not shift its production technique from low to high skill in a progressive way. It's very difficult to change in a progressive way. You'd expect new firms to come up with new technologies and replace old firms. Through creative destruction, if you want. And I think Nitakat, until recently at least, doesn't really allow that, even though we're now seeing more ambitious strategies that take one sector at a time and try to jump higher in one scoop in those particular sectors. And I think that would be the way to go, focusing also the other instruments of support of firm on these sectors one at a time. I simply conclude with this slide. These are countries where the private sector is more or less dynamic. What those bars show you is the rate of entry of firms and exit of firms. The red ones are the exit. And so it goes between 3 and 6%. And as you could see, entry and exit go together in most countries. Countries that have a lot of entry also need to have a lot of exit. If you look on the right at the Eastern European countries, Hungary, Slovenia, for example, a lot of large firms that were there during the communist era have been exiting, and they are replaced by much more entry of small firms. And so I think we should focus much more on understanding the market dynamics in order to be able to coordinate industrial policies better over time. I will conclude with this.
Thank you, Ishaq, very much. That was very insightful. I want to see if Jeff is available with his slides. Jeff, have you managed? Oh, excellent.
You able to see slides now?
Excellent. Thank you.
Yeah. Okay.
Have the floor. Please go ahead.
Okay. Thank you. Okay. So let me just go a bit briefly. I very much enjoyed the previous discussion of Ishaq about Nitakat and so on. So I want to focus on a number of sort of key things, it seems to me, for the Gulf region in this day and age with maybe low oil prices remaining for quite a while. So so all the countries that in the Gulf, they seem to have fixed exchange rates, and therefore fiscal policy is crucial macro kind of policy. And it needs to avoid pro-cyclicality, and it's the volatility of it's not oil revenues that are the problem, oil rents, but the sort of crisis or the oil curse, so to speak, is the only to the extent that it leads to this volatility in revenues and then spending and so on. So you need a more counter-cyclical type of policy. And I think there's great room for improvement. The fiscal policy in the Gulf has not been very good in this respect. It varies a little bit from country to country. With that volatility comes quite naturally high non-performing loan rates, bankruptcies, and things like that. So the more you can smooth out and get rid of the volatility, you're going to be better off in that respect. So despite all the GCC countries being much better in terms of political economy than the other resource-rich Arab economies like Iraq and Yemen, but each one, as you know, has its own sort of problems, and I'm sure you're aware of more than I am. Bahrain, with a royal family that's a religious minority. Kuwait being relatively democratic, but the parliament, to the extent it gets involved in budget making and decision making, often they sort of keep adding expenditures to make it less balanced and less. So UAE is a federation with a federal government, but the federal government doesn't have much control over the budgets of the individual emirates, and yet it has lots of responsibility. The Saudi Arabia kingdom has unusually large royal family. It has ambitious programs of trying to diversify, which are really exciting, but challenges. Qatar has major constraints on its economies being imposed by its neighbors, but it's also been very active in trying to do things internationally and intervene in other countries. And both Oman and Bahrain have faced this declining oil reserves. So governance needs, there are many. So if the GCCs are not becoming democracies, which seems to be far off, they do need to reflect the needs and desires of their growing educated youth. And it needs to and thereby weaken the entrenched privileged positions that Ishaq was talking about, this problem of the insiders and getting too cozy with the government if you're trying to coordinate. Strengthen civil societies, not suppress dissent. Raise scores on all these indexes, the World Bank governance indexes, the doing business indicators, and other governance indicators. Improve transparency so that the citizenry and the business community can have more trust and confidence in that governments are doing things in their long-term interest, and trying to work with them and coordinate with them instead of the old authoritarian contract. Pay attention to these governance needs, especially relevant to banks and bank credit, so that domestic investors will want to use, and both foreign and domestic investors will want to use local banks and therefore build up the credit base in the economy. Because that is, as Ishaq emphasized, there's going to be lots of challenge in terms of trying to finance the expansion of SMEs and even the very small firms. So at the present, in terms of, so FDI, attracting FDI is going to be very, very important. Get that investment from outside to complement your own activities. But to do this, you need to maintain these fixed exchange rates, possibly improve upon them in a way, for example, suggested by Jeff Frankel. Strengthen minority investor protections. This is made a theme in the IMF 2018 review of all these issues for Gulf countries. Remove restrictions on repatriation of capital, loosen the ceilings on foreign ownership, as UAE has done. Reduce legal ambiguities in GCC election. Follow maybe the Singapore model in terms of target incentive, where you put incentives, target them to specific areas and industries that could be of great usefulness, like biotechnology, but not causing any environmental degradation. Strengthen dispute resolution procedures. These long terms in resolving these are what lead to the non-performing loans. Strengthen mechanisms to promote competition, especially of private firms, and trade openness. A more flexible labor regulations that can, so Gulf already has relatively flexible labor regulations, but they need to be still further smoothed out. So that they apply to both nationals as well as foreign workers. Improve those where you do have SOEs still operating in their things, try to improve them so that maybe they could be privatized. Especially useful, so again, we need to think about trying to introduce foreign sector FDI into banking, because foreign banks have been shown to be rather productive in terms of the banking sector relative to domestically owned banks. Match institutional and institutional rules and education to private sector needs. So the UAE has done very nice in establishing these different zones, allowing each of these zones to develop their own rules that are appropriate to that particular industry. So let the specific industries and universities and so on design their own rules to make it work well. Foster business associations for success and collective action in doing things in an efficient way. China example of huge ACFIC in China, that's in a communist country, that's done an amazing amount to really boost the private sector and make the rules fit better for the private sector. Raise the quality of education and channel the education to the needs of the more diversified and private sector oriented economy. I understand that there's a Professor Nuzzaman who's been talking about that recently. Avoid fragmentation of countries. So encourage, and I meant that is of one country fragmented from another country, the region fragmented. So this is what Malik and Awadallah trace back to the Arab Spring. And the Arab Spring is is in principle there for all the countries in the region. This problem of that there's not enough coordination between the countries. And so one way to do that is put your infrastructure at the borders and share this infrastructure and then attract firms to come to those sectors. Reduce non-tariff barriers to trade, which are more serious than the tariff barriers that are pretty low in the Gulf. Promote trade, FDI, and cooperation with other countries, not just the Gulf, but outside the other Arab countries. This is where intra-regional trade is so low and needs to be promoted, but so coordinating with other Arab countries and perhaps with Iran, perhaps with countries outside the region, Singapore and so on. Recently has come up the case of Israel with the newly proposed agreements with the UAE and Bahrain and maybe Sudan. But I would say to do so in a way in which the benefits that would come from like this DIW firm and helping Israeli ports and shipping, why not make that also so it would apply to Palestinian territories? And if you did that, it seems to me this idea of working with Israel to promote the regional trade would be more satisfactory and more acceptable to other countries. So actions to accelerate growth of the private sector. These are well known to you also. I just skip over them very, very briefly. Access to credit, that's crucial. Introduce reform and banking rules to facilitate expansion. Dispute resolution that I already mentioned. Just mention one that's come to my mind is in order to get credit, to loosen the rules with respect to what counts as collateral. So the West Bank and Gaza did this in 2016, and I followed before and after in West Bank and Gaza. You've seen some impacts of that on credit expansion. Promote tourism, especially in places where it needs to be further developed and has the potential would be like in Oman. Undertake enterprise surveys. Why do we not have enterprise surveys? Allow them to exist so we can identify the problems that exist in each different type of industry. I think Ashok mentioned that too. Reduce political instability, strengthen Polcon index so that that's going to help grow the private sector if people can have more confidence in political stability. Improve the match between the youth worker skills and needs and the need for nationals to work in these sectors in the Gulf region. Liberalize the labor regulations on working hours, perhaps, in order, if you have, so that firms will be able to meet deadlines that they have to meet, and to encourage training within private sector firms. Strengthen the sovereign wealth funds. So I think that all the sovereign wealth funds in the region should join the Sovereign Wealth Fund Institute so they can share the common sense of experience and learn from each other what the problems are. And the case that comes to my mind is to see the impact that can have, like in Oman. This PhD dissertation, I don't know whether any of you know about that, but there was a PhD dissertation done in England by an Omani about their sovereign wealth fund and compared it to Norway's and how it operated. And of course, it was just enormously different. And that got back to Oman. And soon after that, Oman joined the Sovereign Wealth Fund Institute. They're now, I think, a board member there. And they introduced on the SGR website, they introduced this watchdog procedure so if somebody sees a problem, they can be protected, so that's not their concerns will not be totally voided. Okay, my last slide is, I think, a serious issue about, at the same time in the Gulf, I think there's potential for lots of disasters that really the Gulf really needs to work together and really protect against these disasters. So one of these, for example, would be with COVID that we were talking about before, and so that the contagion between countries is a big issue, and therefore you have to coordinate your policies and the travel between the countries. So dealing with this is one example of where to avoid real disasters. I mean, this thing could keep spreading and shut down economies for long periods of time. So it needs to be coordinated and dealt with kind of urgently. But then about environment, the enormous and increasing concern for, in the Gulf as a whole, water scarcity, declining underground water, especially in Saudi Arabia, nuclear energy rising all around the Gulf, underwater oil drilling, and then the huge shipping in the Gulf, potential for accidents. So this is really so many risks, and they overlap. That if something explodes here, that can cause problems in either another country or even in that same country, but in a different industry. So we just had a PhD dissertation done by Hena Al-Khanai that really dramatized that. The Gulf has to get together for potential crises. There's so little information sharing about this. And so it's potential for disaster, more than probably anywhere else in the world. And then moving in the direction of renewable energy, and that's can be a potentially great industry itself. And then avoid the risk of war due to miscalculations. This UN Security Council meeting that just took place, I think brought up a lot of those challenges and the risks of that and need to be done, and make up for the loss of Kuwait's Sheikh Sabah, who was so good at sort of peacekeeping in the region. So with that, I stop.
Thank you, Jeff. Thank you very much.
Thank you so much.
Thank you. Thank you very much. Thank you. I'm conscious of time because we're all trying to say a lot of things and pack it together. I would now ask Ahmed to please have the floor and share with us in possibly 15 minutes, but you can also take another 15 and then we all go to sleep. But please, you have the floor.
Okay, thanks. I'll actually take much less than 15. I'm not an economist, although I do love slides, but I only have one slide to share. And actually, it's not mine. It's something that I stole from the IMF. Let's see if I can bring it up. No, I can't. Huh. Yeah, for some reason it's not allowing me to. Anyway, since it's only one slide, I don't think it really matters. But let me give a bit of backdrop here. As not an economist and really as an investor, I tend to look at countries the way I look at companies, and so I take sort of a financial analyst's view of countries and look at their balance sheets and income statements, and with those dual pictures, if you put them together, you can distill something that financial analysts sort of summarize as operating leverage, and that goes to the relative degree of fixed costs you have in your income statement, and the impact that could have on a deterioration in your equity base as a company. The IMF issued a really good report earlier this year about how sustainable the fiscal side of the GCC, effectively how sustainable their income statements were in light of the potential of a significantly weaker oil environment going forward. And in the analysis that they did, they put these two pictures together essentially, and showed, you know, the impact that very high, somewhat chronic fiscal deficits would have on what now stands to be some of the best balance sheets, sovereign balance sheets globally. And in summary, essentially, even assuming a $55 oil price environment, the GCC countries essentially have anywhere from 10 to 15 years until their balance sheets and the net asset value is completely deteriorated to zero. So with this picture in mind, for us as financial analysts, we kind of try and look for the elephant in the room, and what is at the core of this very high risk of negative operating leverage. And in our opinion, the core problem really lies with the social contract between governments and the nationals of the GCC states. And that really is where that rigid fixed cost element resides. It really resides just there. And as a result, you know, you have things like in Kuwait, where anywhere from 2/3 to 70% of the fiscus is being spent on public sector wages and entitlements, and that share has grown significantly over the last few years, particularly in a weaker oil price environment. From that social contract, everything kind of flows out of it. So if you start with that unsustainable social contract, you end up trying to adapt to it by adopting a growth model that's dependent on migrant labor, imported migrant labor. And effectively all of the GCC countries, inclusive of Saudi Arabia, have effectively become very drunk on this resource. And what that creates is it creates some of the lowest sort of labor productivity growth rates that we've seen anywhere in the world. I think the UAE and Qatar probably have some of the lowest labor productivity rates globally. So this rigid and unsustainable fiscal posture and the low productivity backdrop have effectively created very little wiggle room for many of these GCC states to try and adapt to what will likely be a very low oil price environment. And what you do have is a very dangerous business model where the high negative operating leverage can wipe out all of your equity in a very short period of time. And so time really isn't a benefit that many of these countries have. They need to adapt quickly. We think the solution really has to be addressing the elephant in the room and really aggressively restructuring this social contract. The balance sheets do have, they look very good, and I think there's a fairly good runway for most of the countries to begin the process of restructuring this contract. We don't think it can be a gradual or incremental process. We really think it needs to be structural in nature. There's been talk about the more social alternatives, like adopting a universal basic income for some countries, where effectively you're subsidizing the nationals and trying to incentivize them through subsidies to enter the private sector. We don't think that's a very sustainable alternative. The solutions we do believe the GCC countries should adopt after they've addressed the elephant in the room is really focus on privatization, and as a result sort of shrink the state dominance in the real economy. And I mean, the evidence is abound, and we've written about this extensively, of how this state dominance and the lack of competition has really destroyed profitability in most of the successful companies that are listed on in GCC stock exchanges. But with an aggressive privatization of state-owned entities, and that includes the national oil companies, we think that'll at least start to create room for the real economies to broaden out and also enable the private sector to absorb more of the unemployed nationals. And finally, I would say, on the monetary and fiscal side, we would be huge advocates for the Gulf countries to essentially reclaim their sovereignty on the monetary side by getting rid of the dollar pegs. The dollar pegs effectively abdicate any type of monetary flexibility, and as a result, what it does is it takes what's a rigid, failing model and freezes it. It doesn't allow any type of competitiveness to be gained through monetary channels, and it also eliminates a lot of the fiscal flexibility that you get with a more flexible monetary model. So I'll end there, and I'm look forward to the Q&A.
Ahmed, thank you very much. What I failed to do when I introduced you is to say that the reason why we chose to have you, Tarek, and Amjad is purely because you are people involved in the marketplace from your own vantage point. And I think that your research and your thinking proves that. And thank you very much. It's exactly what many of us have been thinking. And I want to pass the floor to Tarek. Tarek, this is a nice segue into what Ahmed said, because you have been thinking for a long time along these lines, and you have been looking at firms in the GCC. Excellent research, and I really, enjoy reading it always. So Tarek, I give the floor to you, please.
Great, thank you very much, John. Thank you for the invitation, and thanks to the Gulf Research Center for giving me this opportunity. As you said, John, I will be looking at the next 4 slides from the lens of an investor, both in the debt as well as the equity markets. And I think the first thing to say is, for all the talk about diversification, and God knows we've been talking about it for literally decades in this region, it's still in 2020 all about oil. And the slide that I hope you can see demonstrate that in terms of both equities and the bond markets. So on the left-hand side, you see the government budget balances that are forecast by Oxford Economics. And you can see the I guess, yellow lines for last year, the red lines for 2020, and then the blue bars for next year. And what's clear from this chart is that there's going to be an awful lot of deficit financing over the next 2-3 years. And that has huge implications for the economies. It has huge implications for the way that governments go about their business. Clearly, as they continue to access and tap the capital markets, investors will want to see plans as to how they intend to pay back. They want to see transparency. And of course, all of this is against a background of increasing sensitivity to ESG and decarbonization. So this is a huge challenge for governments, which in aggregate, according to S&P, are going to be looking to raise something around $500 billion over the next 3 years. It's a massive ask, given where they've been historically. On the right-hand side of the chart, you can see the correlation between oil and the Saudi, the Tadawul All-Share Index, the TASI. And here you can see that, again, historically speaking, the correlation has been quite high, but very recently, the stock market has been on a tear, even as the oil prices have gone down. Now, if we take a step back and we look at how the stock markets have behaved this year, you could argue that the Saudi Arabian market has been relatively insulated until very recently, until the last 3 or 4 days when the market has seen something of a sell-off. But if you look at where the MSCI World is and where the MSCI Emerging Market Index is, the Saudi market has actually not been such a bad performer. In fact, until recently, it was in positive territory in terms of the year-to-date performance. But contrast that with Dubai, which, as you all know, is highly sensitive to aviation, tourism, hospitality, and property, all of which have been unfortunately hit very, very badly by the COVID pandemic. But what that means is that as earnings have declined in Saudi Arabia and stocks have remained relatively elevated, you've seen an expansion in multiples, in valuation multiples. And that you can see perhaps most clearly in the chart on the left-hand side, which takes the price-earnings ratio for the TASI going all the way back to the bubble peak in 2006. And although we are not anywhere near those levels at the moment, it's quite easy to see that at around 30 times price to earnings, the markets are relatively expensive to where they have been for much of the last 14 or 15 years. So clearly this is something that we need to think about, especially when we contrast it with what's going on in the rest of the world. So the table on the right shows you the price to earnings ratio for the TASI compared to the MSCI emerging market. And there you can see that the TASI is trading at a premium of around 39%. Now that premium is not quite as high when you look at the price to book ratio, or where you look at the enterprise value to EBITDA multiples, but nonetheless, on an earnings basis, it is suggesting that profits would need to grow between 25 to 40% over the next year, year and a half, in order to make sense of current valuations. That, of course, is possible, but I think most people would agree that's likely to be difficult. And one of the reasons why it's likely to be difficult is that the oil sector looks to be under continued and continuous pressure. And this is something that is not just COVID related. This is a trend that you can trace back to around 2012, 2013, when the oil sector started to underperform the rest of the market. So the table that I have on this slide shows the Bloomberg World Index. It's kind of an MSCI World proxy. And then below that, you can see the World Oil and Gas Index. That's an index containing the largest oil companies in the world. It includes Exxon and Chevron and Luke Oil and sort of all the big names. Aramco is included in that index now as well. And then, of course, you have the coal index below that. And what you can see from this chart is over the last year, the oil and gas index is down 29% compared to a world index, which has risen 8%. Over 5 years, the discrepancy is even more stark, where the Bloomberg World has gone up 34% and the world oil and gas has gone down 25%. And of course, the question is this a temporary phenomenon or is this more of a structural development? And if it's a structural development, then how will that impact oil revenues and how will that impact government spending? And of course, as an investor, I want to know how is that going to impact corporate profitability? And the final slide that I have here is one that I recently built on the basis of IMF forecasts. As you know, a week ago, the IMF came out with its revised forecasts for the world and for the region. And it suggested a slow recovery, although the actual number for Saudi Arabia was revised up for this year, it's still forecast to decline around 5.4% and to recover only 3.1% in 2021. The numbers for the UAE are slightly worse, a decline of 6.6% this year and a very modest recovery of 1.3% next year. So given the base effect of declines that we will see this year, it's going to be at least another year and a half or maybe even 2.5 years before the economies, the large economies in the region, namely Saudi and the UAE, go back to where they were in December of 2019. And this is really a delay, an unnecessary and definitely unwelcome delay to the diversification efforts of these countries. And what that says to me is that the kind of industrial policies that my esteemed colleagues were talking about earlier have to be implemented with massive acceleration, because time is not a friend. And I also think that in addition to better governance that Jeff alluded to for the sovereign wealth funds, we definitely need to see them step up in terms of their activity domestically, locally, regionally, both on the debt side of the local markets as well as the equity side of the local markets. So my view as an investor is one of caution. There is a lot to do, but hopes remain still high. That's my presentation.
Thank you, Tariq. Thank you very much. Very insightful, always very interesting. It begs the question that not just governance, as you said, but also the price of oil. We tend to forget, or policymakers in the region tend to forget, that in order to diversify, they would need the price of oil to be relatively high and probably even higher than what we have today. And if it goes down, the diversification becomes far more dicier. I would add to the book of all the ideas that were presented previously, that another idea that needs to be added is that of prioritization. They need to prioritize, but also they need to understand what is exactly their comparative and competitive advantage, because it seems that they're all doing the same thing once again. Tourism seems to be the latest catch phrase, and that in a post-COVID environment, whenever we get there, that will be a challenge. I don't want to say more. I want to really pass the floor now to Amjad, who is another very successful market participant for many, many years. He led a fantastic business on the private equity side, and now he is sitting at the Atlantic Council, amongst other things, trying to think of the region. And I couldn't think of anybody else to really talk to us about the role of the private sector, private equity, and really his perception of what is the future.
Thank you, John. It's nice to be part of a group where you're learning. So it's some great presentations. So I think everyone really set the scene very well. But I just wanted to rewind for the last 15 years, what we've seen specifically on the private market side. I think you saw a fantastic sort of private market ride over a decade, primarily driven by, of course, the high oil prices that trickled down to many sectors and allowed many of us to prosper during that period. However, what you saw clearly happen as oil prices started declining is a dramatic change in the local environment, which I think all of you have alluded to. We are still not uncorrelated from oil and what oil does, which is unfortunate, because I think those were the years that we should have probably pushed more on diversification. So we've seen a significant slowdown, and it begs the question, will you ever come back to that type of growth and that type of environment? And my clear analysis says no. I think if you're betting on oil in the next decade or for the foreseeable future, I would say good luck. there's just a confluence of factors that are causing oil prices to continue to be this low and will probably persist for, I would say, decades to come. So the issue is that how does the GCC react to this? And I do think this is a pivotal moment, and I think that there is no time to waste. Today, where we see opportunity and where I myself pivoted about 5 years ago is technology. I started investing heavily in venture capital, and that's done well, but I think we need to be very aware that this doesn't mean that the pie is growing. The pie is shifting. So business is probably the same, but it's moving from traditional business to technology businesses, but that cycle will also at some stage stop. So this is sort of a short to midterm opportunity. What you really need is real economic growth and activity on a general level. And for me, what that means is a dramatic change in how the environment is to allow FDI, because I think without FDI, I think we all have come to the analysis that reserves are not going to cut it for the next, some countries are 30 years, some countries are 10. But the minute Saudi Arabia sort of coughs, we're all going to catch a cold, right? So, and it's the first probably to go in terms of reserves. So what I think is to drive real FDI, you need dynamic economies. And what that means to me is accessibility to 4 things. 1, accessibility to information. We cannot continue to be so opaque in the region. If you want investors to invest, they have to have clarity on market share, on the movement of goods and services, on laws, on all of these things have to be very transparent and have to be certain. We don't have to like them, but we have to know that they're certain and that they're there and that they're accessible. 2 is accessibility to talent. And that can mean local, it can mean foreign, whatever makes sense for me to scale my company and to start my company, I need to be able to do. I think it's not a secret that we need to fix our talent pipeline regionally, and that's all the countries, not just the GCC. So that needs to be fixed. But in the meantime, you have to make talent accessible. People have to be able to come in and out as companies and as the economy sees fit. I don't think the right solution is to try to push localization versus you need a dynamic economy, you need good education, and then you have competition for talent. And that's the way it should be. Third is capital. I think there's a misconception that capital is available. I can tell you firsthand, it's not. Whether on the equity side or on the credit side, it is very difficult to raise capital. And the reason why I think you have a lot of legacy companies that have sort of stayed where they are is they cannot access funds. So even when they have ideas, it's very challenging to get those funds. And let's remember, it's also funds at the right cost. Sometimes funds are available, but the cost is very prohibitive. So we need equity growth and we need credit growth as well. And then last but not least, and I think this is a really important point, probably one of the most important points out of these 4 in terms of accessibility, is given the size of our economies in the region, we need accessibility to markets. Take China as an example. China has a lot of problems, but every investor in the world has gone and put money in China, in spite of all the issues, in spite of political issues, in spite of transparency issues. I mean, the list can go on and on, but what you have is a massive market that is accessible, that you can build businesses. We don't have that. Even Saudi Arabia, which is the biggest Arab economy, is not big enough to build champions for the region on its own. It needs the accessibility of adjacent markets. And what I would argue is not only should you open up regional markets, but you should even explore markets outside of that as well, whether it's Africa, Southeast Asia, but economies need to have and businesses need to have accessibility to markets to scale. In a nutshell, what all of this reducing the barriers to all of this and accessibility of all of these issues will allow you to create, number one, more companies, which you need, because you will have failure. But on the other hand, it will also allow you to scale companies. And there are plenty of economies around the world where you see small local markets, but because of their accessibility to other markets, they've built phenomenal global companies and phenomenal regional companies. So we need the market to open up. We need it to be regionally integrated to some degree. It doesn't have to be perfect. But again, we need to accelerate the cycle of building, failing, scaling. The more competition we have in terms of corporates, the better it becomes. Many of you have mentioned this already about state-owned enterprises. They have been a huge hindrance to growth, but I would also argue that so have been the large conglomerate elites have also been a hindrance to growth, because in many ways we see them one and the same. Because of their accessibility to government, they're almost like the government. So the large conglomerates as well as the sovereign entities have really caused a lack of competition in the market, given that they have preferential treatment on almost anything, including these four accessibility areas.
Great. Amjad, fantastic. Thank you. Thank you very much. I couldn't agree more. I think that this is a lot to think about, but right on the mark. And as always, my good friend and colleague, Don Babai, who sits in Boston, always asks me to think about the environment. And I don't do enough to think about the environment. And more recently, I had the opportunity to meet and find out about the wonderful work that Aisha has been doing on the environment and in thinking about the Gulf. And although she's not an economist, it's very important to think about the future of the Gulf within this debate of the environment. And I want to give the floor to Aisha, who has been doing tremendous work on some of these topics. Aisha, the floor is all yours. Thank you.
Okay. Thank you very much, John. And thanks also for the Gulf Research Center for organizing this panel. Yeah, so I truly appreciate involving, as environmentalist, involving the environmental perspective alongside economic discussion, because I believe this is really important for the reasons that I'm going to mention in the next few minutes. So indeed, I mean, I've learned a lot from my colleagues, and yes, I'm not an economist by background, but yeah, for the Gulf Arab states have been blessed with the oil wealth. So what I'm going to do next is to look whether the economic development of the Gulf is going in line of protecting its natural environment or not. So the oil wealth has helped the Gulf Arab states to achieve dramatic progress in the economic development over the past 4 to 5 decades. However, unlike any other parts of the world, economic development in the Gulf has been unique for 2 main reasons. The first one, because it has been centralized around the oil wealth, which supported all contemporary life functions such as water, food, air conditioning, urbanization, transport. And the second one is the GCC economic development has taken place in a unique, harsh environment characterized by high temperature, low rainfall, scarce food and water resources, amongst others. So from environmental perspective, it's really important to question like whether this progressive GCC economic development has been sustainable or not. And in order to avoid confusion on what do we mean by sustainable, because I know like sustainable means many things for too many people, but from environmental perspective, I would refer to the 1987 Brundtland Commission report, which made the first attempt to define sustainability by emphasizing on the unity between natural environment and development. So Brundtland Commission report defines sustainable development as the kind of development that meets the needs of the present without compromising the ability of future generations. Now, with this definition in mind, and despite the GCC states have made a progress to integrate sustainability in their economic development, I can say that GCC economic development today is far from being sustainable. And that is without immediate proper management. And for the examples that I'm going to give next, I can say the GCC future generations might not enjoy the same lifestyle that we enjoy today. So let me give you a few examples. So if we look at the water, so the region has experienced 140% rise in water demand over the past decade. And because the rate of withdrawing groundwater, and thanks for Jeff to pointing out to some of those environmental challenges, so the withdrawal of groundwater has been almost 3 to 4 times higher than the replenishment rate. And all the GCC nations are currently under the water poverty threshold of 1,000 cubic meter. So the renewable fresh water per person per year currently stands at 103 cubic meter on average. And in Kuwait, UAE, and Qatar, it is already 30 cubic meter. At the moment, 50 to 100% of all water supply in the region come from desalination, which is energy intensive and relies on the oil and gas for their operation. A second element that I want to point out too is the air pollution. So what we have seen in the GCC, we have seen growth in the energy intensive industries, and even those that are currently supporting the economic diversification, they have some implications to the air quality. We also have seen rapid urbanization, expansion of desalination unit, growth of transportation. All of these are currently relying on the oil and gas supplies for their operation and have led to deteriorating the air quality across the region, the GCC. So just to give an example and put this into perspective, recent data from Mohammed bin Rashid Space Center showed that 30%, there was 30% decline in nitrogen dioxide emissions from across the GCC during the lockdown period, because we know the GCC have put some restrictions on the transport sector to counter the spread of the coronavirus. A third element is the desertification and land degradation. So as mentioned, the development in the GCC has happened in a harsh environment, desert environment. So the arable land in the GCC account for only 1% of total land. And because of the expansion of construction, manufacturing, unsustainable agricultural practices, exacerbated by the climate change, all of those have led to decline of the arable land and desertification. And when I say climate change, how the climate change contribute in desertification, there are some studies that shows that elongated periods of a drought lead to 70% rise in sandstorms. A fourth element is waste management. So GCC countries have amongst the top countries in the world in terms of their high per capita waste generation. And despite the progress that have been done to manage the municipal and industrial waste in a sustainable manner, at the moment, 70 to 100% of GCC waste still end up in dump sites and sanitary landfills that do not meet environmental standards. So the waste recycling is still nascent across the region. And if I can give an example, if we look at the plastic, there's only 10% of plastic is currently recycled across the region. And the implications of this improper waste management leads to deteriorating the groundwater, soil, and marine environment. And talking about the coastal and marine ecosystems, again, we have spread of urban areas along the coastline. We have the development of ports and industries, the discharge of brine from desalination plant units, oil spills that happens sometimes. All these, along with the climate change induced effects such as the sea level rise or flood risks, these lead to the degradation of GCC coastal and marine environment. An important element is the energy. Energy is meeting almost all the needs of the water, electricity, industries, and transport. And it accounts for 99% of primary energy consumption at the moment. And we have seen a surge of almost 5% per year for the energy demand most recently across the region. So that has, from environmental perspective, that has led to an increase or continuous growth in the greenhouse gas emissions, which are currently accounting for 2.6% of total global emissions. And also because of the heavy reliance on the oil and gas for operating almost everything. So the GCC states are amongst the top in the world in terms of their per capita carbon emissions. And according to IRENA, the share of renewable energy in the region's total electricity capacity at the moment is still less than 1%. And a last element is the climate change. So it has been proved that climate change has affected the region already. It has affected both the non-oil economic sector, and it has the potential to affect oil-based economic sectors. In terms of the non-oil economic sectors, climate change has impacted the agriculture, water, fishery, tourism, infrastructure, through, for example, the rise in the temperature, falling annual rainfall, sea level rise, and an increase in the exposure to extreme weather events like intense rainfall. So there is a study that shows that the impact of 3-degree warming could cause the GCC large GDP losses of about 0.2 to 0.5 yearly after 2027, or about 1.5 to 3% yearly decline from 2067. In terms of the impact of the climate change on the economic sustainability of the oil-based sector, as colleagues mentioned, there could be implications due to the international policies to tackle climate change through attempts to reduce fossil fuel consumption and the global low carbon energy transitions, which could, of course, lead to a decline in the demand of oil or further decline for oil prices. So with that, I'm not here to say that the policymakers across the GCC are not aware of the environmental challenges. Instead, yes, the policymakers have been aware of the environmental challenges and have played a role in addressing those challenges via regulations and initiatives. I'm going to give you examples about the those initiatives. One is the GCC states have signed and ratified many international environment and climate treaties, such as the United Nations Framework Convention on Climate Change and the Paris Climate Accord. Also, all of the GCC countries have established environmental organizations and institutional architectures that are dedicated to address the environment and climate-related issues. On the energy front, despite the low share of renewable energy at the moment, all the GCC states have renewable energy and energy efficiency targets. And examples for the initiatives to achieve those targets is the Saudi Green Building Forum and the Saudi Energy Efficiency Center, which has been established in 2012. And it really helped, along with the price reforms, in reducing the electricity consumption in Saudi Arabia. And we have also another example of Dubai Integrated Energy Strategy 2030. At the economy-wide level, the UAE put the example, and it is the first Gulf country to adopt a green growth strategy. And this year, as we might all know, the Saudi Arabia is hosting the G20. So for that, Saudi Arabia has proposed a circular carbon economy approach, which aims to mitigate carbon emissions associated with carbon-intensive industries. And I have been coordinating the task force for the T20 on climate change and environment, and that gives a clue also about how interested Saudi Arabia on addressing the climate and environment issues. So that being said, and despite again the ongoing progress to address the environmental challenges brought by the economic development in the GCC, I can still say, and given the examples that I mentioned, GCC economic development is still far from from being called sustainable. And from my perspective, one of the major reasons why economic development has been disconnected from its natural environment, because there's a belief that investing in environmental sustainability options or climate actions is a costly option. And there is a lack actually of the awareness about the opportunities that could be brought by aligning economic development with the environmental protection. So I'm going to conclude with a few examples of the opportunities that can be tapped by aligning economic development with the environmental protection. And these include, for example, if we invest in renewables, and I'm going to be a little bit theoretical here because I didn't have enough GCC specific data, but a UK study shows that if we invest $1 million in renewables, then we could create 5 more jobs compared if we invest the same amount on the fossil fuels. A relevant study for the GCC states shows that if the GCC have chosen to make a 100% transition to the renewable, then there are going to be many social, economic, and environmental benefits. And these include creating around 50,000 to 500,000 jobs in the long run, reducing or improving the energy security by reducing the energy demand by up to 60%, and reducing the air pollution and health cost by saving around 1 to 3% of the GDP. And as colleague mentions, for the Gulf countries to diversify their needs to attract the foreign direct investment, there's the need to create the environment for small, medium enterprises. So the renewable energy efficiency electric vehicles. These are going to create a new market for the region, and it could enhance the long-term resilience and sustainability of the economy, unlike the volatility of dealing with the volatility of the oil prices. And another point, if the GCC also choose to join the global forces in advancing their climate action and sustainability, then they could actually enhance their competitiveness in the future energy market beyond the oil. So if we look at the GCC top trade partners such as the EU, Japan, India, and China, actually all of them at the moment has pledges to cut greenhouse gas emissions and reduce dependence on the imported oil. A last point I want to point out too, also the importance of shifting the thinking from linear economy to circular economy. At the moment in the Gulf, we are still developing based on the linear economy. The circular economy is still very nascent concept and idea in the region, but theoretically there are studies that shows circular economy can unlock around $4.5 trillion in new economic growth by 2030 and can contribute to creating jobs and helping to create a market for small, medium enterprises along the value chains. And I conclude with that. Thank you very much.
Thank you, Aisha. Thank you very much. I know that we have been doing this for an hour and a half, and some of you have other things to do and need to allow you to go. However, it's really a unique privilege to have you all in one webinar, and I want to give the opportunity to all of you to say something. And I want to basically pick on certain themes that were mentioned by some of you, and I will start the ideas by saying that Ahmed, you mentioned privatization, very important. I agree with you. And Amjad, you mentioned equally important access to information, like Ishaq. He has no information to see who exits, who enters. Aisha pointed that out as well. Access to information is for the few, for the privileged, for the conglomerates. This is very important, Amjad, because you were in the private equity space. You managed billions of dollars. And Ishaq, you and I have written a lot about crony capitalism, and we need to think how that comes into play. The cronies are the powerful. There are not too many of them, and they've existed for many decades. They're not necessarily to be defined as crony, but they're still in output terms very similar to the cronies that we've seen in other places outside of the Middle East. Ahmed and Amjad, I want you to try and tackle a little bit the issue of privatization. Where are we? What needs to be done? Yes, we have talked about it. Egypt has privatized. The economy is not doing great, however. Let's think of the Gulf. Access, Amjad, to information. How do we change that? The youth, technology, the issue of capital concentration. Amjad, Ahmed. Amjad, go first.
Okay. So yeah, I've done some thinking about this. I mean, I think privatization is definitely the right approach to get the government out. I think the government needs to sort of transition now from a provider for many things and services and capital and so on and so forth to more of a facilitator in many of these economies, which is critical. But I think privatization alone, without having the dynamicism of an economy where you're building and scaling other corporates is not the right way to go. Because eventually what you'll end up doing is you privatize to probably the same cronies that you're mentioning, and you're just going to make those companies even bigger and even more powerful. So I think you need both at the same time. The information issue for me is relatively straightforward. You have to start having a culture of transparency, of saying, we're the government. You can go to our website. You can see what's being bought and sold, who are the companies, who are heading these companies, and so on and so forth. So that to me is probably one of the easiest things to start doing. And again, I don't think this is counter. A lot of people say this is counter to what they want to do. And let's put politics aside. And I think there's a way for you to make economic data very transparent without sort of impacting your security or your politics in any manner. So I think that is something that should shift, but it's a complete shift in the way we do things. It's a culture that has to start there, and I think the government is the best person to start doing that as soon as possible. I think is allowing great institutions like this to have access to information where you can actually take that information, also dissect it, and make it available in a format that I think investors globally can dissect and read and understand. So I think that would also be very useful. I think what that also does is it helps what I call the facilitator industry. Investment banks, private equity firms, venture capital firms. It makes decision making much easier and much better for them to sort of decide where to put their money, and that definitely holds true for investors outside of the market that don't really understand the nuances as well as we do. I think the one thing I realized in raising capital for the Middle East is there is a huge gap between perceived risk and real risk. And that, to me, a significant portion of that is information. If an investor sitting in London, New York, Hong Kong can have the same access to information as those on the ground, I think that perceived risk and that real risk will shrink, which will in itself open up the market to more investment. The reality is today, capital is global. People can decide to put money in MENA, can decide to put money in China, could decide to put money in the US. We have to attract that capital. And we cannot do it if the threshold to invest is 50% IRR, because they see the perceived risk as being very high. The cost of our capital is going to continue to be massive if we don't have this transparency. I think you're off, you're muted, John.
Thank you, Amjad. Thank you very much. Ahmed, I'm seeking your input.
Yeah, I think all those points are really good ones on privatization. The one thing I would add is by privatizing, what you do is you allow the market mechanisms to work more freely, and you start to attack a lot of the distortions that are created by this sort of over-dominance of state-owned enterprises in most of these economies. And as a result, when those distortions start to melt away, the cost of capital starts to become much more real, more meaningful. But also the way that you allocate your labor resources also starts to normalize as well. So take the example of many of these state-owned airlines that have come that have been created over the last couple of decades, whether it's Emirates Airlines or Etihad or Qatar Airways, and you look at how they've allocated labor, how they've allocated capital in just the fantastic profile of growth that they've had over the last couple of decades. None of these airlines employ a significant percent of nationals in many of these companies. So you're not doing anything by creating these national champions. You're not doing anything to absorb the excess job seekers that are being created amongst nationals in these countries. You're taking advantage of effectively labor cost arbitrage by importing a lot of migrant labor that are cheap in the GCC, but not necessarily cheap in their home countries. And you're using a subsidized form of capital to grow companies at a much faster pace than what the sort of global tradable sector would allow for. And as a result, what you've created is you've created effectively overcapacity in many of these franchises. And arguably, and we've done some detailed financial analysis going back a decade plus on all of these companies, including Emirates, none of them have generated a positive economic value added, which is effectively a return on capital that's in excess of their normalized cost of capital. So by privatizing even national champions like these, let alone national oil companies or national utilities, you start to solve all of these chronic issues all together in sort of a big bang approach. And that's why we think privatization, in addition to restructuring the social contract with nationals, is really the sort of first and most seminal step to addressing these sustainability issues.
Yeah, thank you, Ahmed. I want to give the opportunity for Tarek to also comment on this. But there was a question, and I want to recognize the fact that there is concern about the social contract. And Ahmed, yes, you can privatize, but the economy needs to change as well. If the structure of the economy does not change, then you will have privatization ending up helping and assisting those who have access to capital and information. Tarek, I wanted to hear your comments on what do you think is the challenging bit. It seems that investors will find it more difficult to exercise prudent valuation approaches. How do you see this social contract unfolding when you try to bring in value to your firm, taking into account labor and capital and the difficulties that you have outlined, given that these are, again, very oil-bound economies, and oil is probably the only factor that will motivate towards diversification in the coming years?
Thank you, John. So I think the short answer is that it's going to be pain before gain, okay? And the way that I've always approached the outlook for the GCC economies is there's really only two models in which you can migrate from what is an oil-dependent economy to a diversified economy. One is the way that we have tried to do it over the last 20 years, which is very gradualistic, but perhaps accelerating a little bit now. And the other one's what I call the East European model, which is destroy and rebuild, right? So you think about Eastern Europe and 91, 92, 93, basically overnight the economy has lost 20-25% of their GDP, and you rebuild it on sounder foundations. It's kind of creative destruction. And so, when you go through this process, and if you don't have the money to diversify the economy, or you have a scarcity of money to diversify the economy, as we may be sort of facing over the next 10 years or so, then the answer really is to let the free market, to some extent, I don't want to say to leave it all to the free market, but the free market needs to play a role. And that role means that these companies will have to initially get smaller, but then as the economy becomes more efficient and effective, and you see the productivity gains that Dr. Ishaq spoke about, then I think you start to employ more people in higher paying and more sustainable jobs. And that's how you're going to get the economy on better footing.
No, thank you very much. Jeff and Ishaq, you have written about big themes in the past and micro themes, sectors and economies. And I want you to think a little bit from a distance as to what do you think is feasible. We have gone from the macro to the micro. We all kind of know the challenges. What can be done? Because not everything is possible. And I would take again all of the excellent ideas provided by all of you, the access, the information, inequality, the environmental challenges, the corporate side of things. But from a macro perspective, Jeff and Ishaq, what is feasible? What is doable? Because often enough, as practitioners, it's one thing to do it, but as academics, sometimes we try to describe a lot, and it's difficult for policymakers to exercise. Jeff, I'll give the floor to you. We cannot hear you. Yes. No. One more time.
Yeah.
Yeah.
Okay. Well, it's a good question. I mean, and if I got it right, so you want to know what sort of how to work this kind of sectoral specialization into macro things, and that's
yeah. If we were trying to, let's say, offer advice, what is really doable? Because all of the things that you have described in your slides, I think they're excellent. But sometimes myself on the field, sitting and advising, it's not all together can be done at the same time. If you were to say, okay, these are the 2-3 big things we need to get right. I, for instance, say that what is missing is institutions. That's because I'm an institutions guy. I want to hear what Jeff has to say, and Ishaq, about these kind of big themes.
Okay, well, I think on institutions, more information availability, that giving information about what's going on, making that much more available, and bringing up those scores, how to improve each aspect of governance and bureaucracy, and in the area of finance, especially trying to improve our credit ability to supply credit to those firms. I think that's information, it's governance, it's this risk, dealing with risks and being aware of the risks and what can be done about it. In terms of, I would say, this kind of wanting to focus on something, on certain sectors, what I hear is that maybe this green energy environment is a good one to go in. And very point, which is going to give rise to lots of jobs, and so I think in terms of, and it would be common issue for all institutions. There's so many institutions that need to be improved. Information availability is and access is a large part of that. In terms of areas and sectors, this private, just providing the old authoritarian bargain of creating jobs in the public sector at high salaries and low and not many hours have to work is really a disaster that has to be, so nothing else is going to be really into the private sector and so on until you do something serious about that. So I'll stop there and Ishaq, take over.
Thank you. And then lastly, Aisha, do you want to say something now, or because you will have the floor after Ishaq?
I mean, I can take it later.
Okay. Ishaq.
Yeah, look, I mean, I have a very strong opinion about your question. I think the most constraining factor is the clarity of goals. I think we have to have clear goals. And having worked on many countries and only recently on the Gulf and especially Saudi Arabia, what really strikes me is this divergence between national macro goals, and the kind of stuff Amjad and Ahmad and Tariq are talking about, which is a financial logic. I think there's a big contradiction between the two. The goal, national goal, should not be to maximize the value of assets, but it should really be to maximize the employment of Saudis. Actually, if you think of what is the largest growth opportunity, I think it's national employment. If you go from the current 30+% to 60+% as in OECD countries, and you calculate the present value of that, it's more than the value of oil in the ground, actually. So this is really the growth opportunities. Now, I'm not criticizing the fact that these countries have abnormally, compared to other countries, enormous expat communities. This is how they were built. It made sense in the past. It doesn't make sense in the future. We have moved to a phase where employment is the major factor. So if we have clarity on this, and we understand why, I'm not against foreigners, just that you know they remit abroad, they occupy the service oil that can employ nationals, and there is this technological revolution that allows these nationals now that are educated to work at higher productivity, and they can be taxed, while foreigners hired at the cheapest international rates cannot. So this is how I look at things. And so, for example, when I think of privatization, I think in the current environment, you privatize, you lose national jobs, and private firms, given factor prices, will hire expats, and that's not good. And so there's a sequencing here. The main problem in these countries is that factor prices are not right. You know, there are quotas on foreign laborers, but there is no tariff, so the factor prices are not correct. And until they are fixed, maximizing asset value is different from maximizing national welfare. I think this is a key point to focus on when we think of policy, and it's a big divergence with the way analysts will think about what's good for assets.
Thank you. Thank you,
John, if you'll allow me to ask a question of Professor Ishaq. I take issue with his point about employment. You know, we're limited in time. I'd love to have this discussion perhaps offline later, but the reality is that unemployment is not an issue, is not a huge issue in the GCC. The unemployment rate in the UAE is virtually zero for nationals. The unemployment rate even in Saudi Arabia, which is currently sort of increases, is still relatively modest at 15%, where you had 20-25% in recessions in Europe, for example, after the global financial crisis. Again, in Kuwait, everybody is already employed by the state. All the nationals are employed pretty much by the state. So I'm not sure that asking the state to force the private sector to hire people at high factor costs is the solution. The solution should come from the private sector with government initiatives and not.
Yeah, I would strongly second that. And just point to one thing to Professor Ishaq's comment. The model's broken, right? So you can't, even if you did have to create a lot of employment, you can't do it anymore, particularly when 70 to 80% of the fiscus is being spent to support a very large national workforce. So
exactly.
I mean, so it doesn't. You actually need to create space in the private sector. It's the only way to do it.
That's what I was saying.
Let me, because we're running out of time and we need to be courteous to everybody. Aisha, I want to.
If I could just conclude on this, John. Look, this is the central issue, and perhaps we should have another webinar on it. No time here.
We will.
For me to reply.
I think we should. I think it should be a webinar on this issue and maybe extending it on the social contract. What is feasible, what is not. I will take that as a project for us to do for the GRC. Points well taken. Aisha, please, you have the last word.
Right. I just wanted to follow up on when you said what is feasible and what is doable. So while I was writing my PhD thesis, which was on studying the challenges and the policy and politics for renewable energy deployment in oil-producing countries, the GCC, one of the major issues at that time while I'm writing my thesis was the subsidies. The subsidies for the electricity, the subsidies for water, which have actually made the renewables uncompetitive with the conventional sources of electricity. So now with the drop in the oil prices, that has changed. And also the price, the cost of the technology also has declined. So we actually do have the opportunity now to promote for the renewables, but what is missing is the right regulations. The right regulations and the incentives are not there at the moment. Now during the pandemic, also again, one of the points that I mentioned is that sustainability and the green growth has been viewed as a costly option. And now at the time of the pandemic, perhaps this is also the case at the moment, but there are so low hanging fruits. So we just need to put the regulations out there, for example, for the energy efficiency, because energy efficiency on its own, we can call it an energy by itself. And also one of the issues, and colleagues pointed out to the importance of the privatization and creating the labor market in order to attract the investments. This is also was one of the cases that I pointed out in my PhD thesis. There was the monopoly in the market that prevented the renewable energy investors to enter the market. And so again, we have we need to just play out with what is available at the moment. And yeah, that's it for me.
Thank you. Thank you, Aisha, very much. Thank you. Thank you all very much. It has been great, fantastic, tremendous. Thank you, Jeff, all the way from California. Good morning to you. Jacques, thank you very much. Aisha, Amjad, Ahmed, Tarek, fantastic. Dr. Abdulaziz, you have the final say.
Well, my final say is I need to thank everybody for an outstanding webinar. I've really enjoyed every second of it. And, I took some personal note for a future webinar and future project that we need to work in. I would highly appreciate to keep the group together, and then we can continue exchanging, views and opinion and knowledge between us. But I'd like to thank you all, and sorry that John extended it another half an hour, but it seems to be that he was willing to go for more if he did not realize that he already passed the time that we have allowed. And luckily we had a good attendees also today. What we will do is we will create a summary of the discussion and share it with all of you. So if you feel it's fine, then we can feel good to distribute it and to share it with those whom they have not been able to join us. Many thanks for everybody, and enjoy the rest of your day or evening, wherever you are. Goodbye.
Yeah. Bye-bye. Bye.
Thank you, everyone.
Bye. Bye, Amjad.
Thank you.
Yeah.
Bye.
Thank you very much.
Bye, Ahmed. Tarek, thanks.
Bye.